So the information arbitrage efficiency, what we call it, that is the most important issue with respect to the financial markets. And with respect to that information, the efficient market hypothesis has been formulated. And in the efficient market hypothesis, we have three forms of market efficiency. One is weak form, then we have the semi-strong form, then we have the strong form. So these are the three forms of market efficiency, what basically we discussed in the previous class. We just started the discussion about this, and one by one, if you see that what exactly the different forms of efficiency or how this particular concept of efficiency has the implications from the different market operation perspective, or how this particular degree of efficiency can be measured quantitatively. These are the different issues what basically always we come across whenever we talk about the concept of the market efficiency or the testing this efficient market hypothesis. So if you see that, what do you mean by the weak form of efficient market hypothesis? The weak form of efficient market hypothesis, basically what it tells, that whenever you look at the price of any asset, that price of any asset is already reflecting all the information about the market. And this market information means we are talking about the prices, rates of return, volume of trading, and all kinds of market related information what is required. So all those historical sequence of the prices, whatever thing has happened in the past and whatever thing has basically has happened to that particular company with respect to different financial parameters. So the influence of all those events, influence of all kinds of incident with respect to that company is reflected in the price itself. So the current price is the reflection of all those kind of financial events which have occurred to that particular company. So if it is already reflected through that particular prices, and the current market price already reflect all the past returns and all kinds of market informations, then obviously the past return and other market data should have no relationship with future rates of return. No relationship with the future rate of return. That means the rate of return should be independent across the time. Across the time, the rates of return is independent. What does it mean? It means that by utilizing this past data, it will not be possible to predict the future. By utilizing or by analyzing the past data, it will not be possible to predict the future, because the information or the news which comes to the market, that is random in nature. And once that random information comes to the particular market, and that particular event already has the impact on the prices in that particular period, that is already reflected in that particular period. So in that context, it is not possible to, again, we can say that utilize that information for the return in the future period. So that's why there is some kind of independency always happens across these returns or the prices of the securities over the periods. So the today's, by looking at the today's data, you cannot predict what is going to happen in the future, or by analyzing the historical data, it is not, you are not able to say that whether the price of a particular stock is going to be up or down, or you cannot analyze that any kind of event which has occurred in the market that will have a reflection in the prices in the next day. because we are assuming that the market has already captured this reflection of that particular event today. So if any new event which will come tomorrow, then accordingly the price will react to that. The new event which will come tomorrow, but which new event will come, that is also not known to us. So if that is known to us, then market basically is again inefficient in that particular perspective. So therefore, what we can say, the past data cannot be utilized for prediction of the future. So that is basically weak form of efficient market hypothesis implication. So what we can say that the current prices will reflect all the available information. So because of that, we cannot predict the future by utilizing the past data. That is the first one. And the second form of efficient market hypothesis, that is called the semi-strong form of efficient market hypothesis. What basically it means, if you see, it is basically nothing but the security prices basically reflect all publicly available informations, or the security prices basically adjust very rapidly to the release of all public informations. Okay, that means the semi-strong form of hypothesis encompasses the weak form of hypothesis. Okay, because why? Because the market information basically considered by the weak form of hypothesis, like stock prices, returns, trading volumes, these are all public. These are available to everybody. So the public information basically includes all type of informations like earnings, company has announced the dividends, dividend yield, company's price to book ratio, price to earnings, stock split, stock buyback. So any event which has occurred to the particular company, we are assuming that the informations are basically public information. And also the stock returns, trading volume, then we have the we can say that prices. So these are also the publicly available informations. So what does it mean? What the semi-strong form of hypothesis basically tells? Or any news which comes from the market, from the government, or any political news. So all are basically we can call that publicly available information. So what this hypothesis basically tells, what it implies. So the investors who basically base their decision on any important new informations after it public should not derive above average risk adjusted profits from these transactions, because the security prices should immediately reflect all the new public information. So if your market is semi-strongly efficient and everybody has that level of information, same level of information with them, so any particular kind of group, any particular individual is not going to use that public information to get better return in the market, because the information which has come publicly, that reflection of that particular news is already there in the prices. So prices basically fully reflect that information with them. So if that is basically already reflected in the prices, then, and this particular information which are coming to the market, these are also coming in a random fashion, then it is not basically that always this particular investors and kind of market participants are going to get some kind of above average profits, risk adjusted profits from utilizing this information. So that is basically, we call it the semi-strong form of efficient market hypothesis. Then another form, what we basically call it, the strong form of efficient market hypothesis. Here, The semi-strong form of efficient market hypothesis, if you see, what it basically contains, what basically tells that the stock prices fully reflect all information from the public and as well as the private sources. What it means? It means that no group of investor has the monopolistic access to information relevant to the formation of the prices. Any information which is required for or which has the impact on the prices. So if any particular group has more information and other group has less information, then there is a problem. So one particular group will consistently get more return in comparison to the other group. What do you mean by the private informations? The private informations are basically known to only the company managers, some regulators, to some extent the people who are basically involved internally to that particular company. So they have only that private informations. But if you assume that everybody has that same level of information, then and all the informations are free of cost, and this is available to everyone at the same point of time, then what basically we can conclude that no group of individuals, no group of investors should be able to consistently derive above average risk adjusted returns. So the strong form of efficient market hypothesis that will encompass both weak form and the semi-strong form. And this particular strong form of efficient market hypothesis basically extends the assumptions of efficient markets in which the price basically adjusts rapidly to the release of new public information, and to assume the perfect markets where the information is cost free and it is available to everyone at the same time. So this is what basically what we can say. That means there is no difference such public and private information. Even if you can define them as private information, then that is applicable, that is available to everybody. So because of that, no particular individual or any particular group are able to get always above average return than the other market participants. That is what the concept of the strong form. So if the market is efficient, okay, so what should the investor do if the markets are efficient? If markets are efficient, then what basically always will observe for the technical analysis will not work, because technical analysis is analysis which is basically used to analyze the past data to predict about the future. But if in true sense your market is efficient, then your technical analysis is not going to be valid. And fundamental analysis, if you are doing, what do you mean by the fundamental analysis? The fundamental analysis means analyzing the other factors which have the impact on the asset prices, like macroeconomic fundamentals, like industry related variables, like company related other factors. There are many factors which are affecting the price of a particular security, price of a particular asset. For example, if you take the stock return, the stock price is getting affected by the some of the company wise factors like size of the company, profit of the company, growth of the company, growth opportunity of the company. These are the factors which are affecting the size of the price of a particular stock of a particular company. Then we can have the industry variables, like what kind of industry it is, what is the prospect of the industry, how the industry is going, what is the growth opportunity, what is the industry cycle. All kinds of things will come under what we can say under the industry. Then we have some economic variables, macroeconomic variables like growth rate of GDP, like inflation, political stability, so all kinds of things. So if the fundamental analysis, if you are going for, then it is not valuable if the market is semi-strongly efficient. because anyway, all the informations are publicly available informations are reflected through that. And the investor is not going to get any benefit from that kind of analysis. So if you look at the efficient market hypothesis implication from the money manager's point of view, fund manager's point of view, then they can have always go for investment in a passive way. There is no need to change the positions frequently because our market is highly efficient and all the things are reflected through that. So you hold on for a particular investment for a longer period of time, then accordingly you can get some better return. And if markets are informational efficient, then maintain a correct diversification. You make your portfolio which is properly diversified. Then all kinds of things like transaction cost you can control, manage the tax burden and all these things. That is the common things what basically that is the implications. Basically, if the market is efficient, then what this investor should do. But the major concern is that how do you know that the market is weakly efficient or semi-strongly efficient or strongly efficient? Or if you want to check it, that whether your market is strongly efficient or not, or semi-strongly efficient or not, or weakly efficient or not. So there are different statistical tests what we use to understand basically whether your market is weakly efficient or not. So in this case, you might have already heard, we have broadly, if you see, there are three ways we can test that whether your market is weakly efficient or not. One by one, you will go. First, we can start with the weakly efficient, then you can move towards the semi-strong form of efficient market hypothesis. So one of the ways is basically the statistically we generally go for two types of tests. One is your autocorrelation test. Other one is the Ron test. Other one is the Ron test. And another rule is called the test of the trading rules, or sometimes we call it the filter rule test. That is basically another test, and that also we use to understand whether your market is weakly efficient or not. What do you mean by autocorrelation? Anybody? Yes? Am I audible?
Yes, sir.
Autocorrelation क्या है? What do you mean by correlation, and what do you mean by autocorrelation? What is the basic difference between
So,
these two, or their same?
So correlation तो अगर मतलब उनका जो प्लॉट होता है स्कैटर प्लॉट, ऐसा अगर हम मतलब उससे कोरिलेशन निकाला जा सकता है। अगर पास्ट का कुछ रिलेशन होगा तो शायद ऐसा कुछ हो कि मतलब पास्ट के प्राइसेस या फिर रेट्स का।
तो ऑटो कोरिलेशन क्या है? ऑटो कोरिलेशन
सर पिछले टाइम के रिटर्न और अभी के रिटर्न में सिमिलैरिटी।
Sneha, what you are telling, the relation between past return and current return, that is what you are telling?
Yes, sir.
And correlation?
Correlation सर वो सेम टाइम के उसमें होता है शायद।
सेम टाइम के?
सर मतलब दो डिफरेंट चीजों पे सेम टाइम पे, एंड ऑटो कोरिलेशन सेम चीज का रिटर्न उसके लाइक बोलते हैं।
Okay. So what you are telling, that autocorrelation is about the relationship between different time periods for a single variable.
Yes, sir.
And this correlation is basically the relationship between the two different variables at a particular point of time.
Yes,
am I right? That is what you are telling.
Yes, sir.
Okay. Okay. Yes, the autocorrelation basically talks about the relationship between the different time period of a particular variable. So if the autocorrelation is there, then we can say that the returns or the prices of that particular security are not independent. There is some kind of dependency exists between the different time periods for that particular security. So in that case, we can say the market is inefficient. But if there is no autocorrelation exists between these two different time period for that particular variable, then we can simply say the market is basically weakly efficient. There is no such concept weakly inefficient. We have weakly efficient or inefficient, semi-strongly efficient or inefficient, or strongly efficient or inefficient. So how basically we can test this? How basically we can test this? So already I told you that if the price change in one period is correlated with the price change in others period, then we can say that there is a autocorrelation. So generally, how basically we can calculate this autocorrelation? So if you see that, I'll just share the whiteboard with you. Okay. Generally, autocorrelation is calculated in this way. Sometimes we call it, or you can say that you might have heard about also the coefficient of determination. First, we can calculate the coefficient of determination, which is basically denoted as R square. So what this R square, how this R square is calculated? It is a sigma y plus b sigma xy minus n y bar square divided by sigma y square summation y square minus n y bar square. So here the b is the coefficient. What is how b is calculated? It is sigma xy minus n xy bar divided by your sigma x square minus n x bar square. And obviously, if your b will be calculated, your a will be basically calculated as y bar minus b x bar. So this is the way a and b is calculated, right? So what basically here we are telling, x and y we are assuming on the basis of the two different periods data. So I'll just give you one example, small example, then it will be clear for you what basically we mean in that particular context. I will give you the data in the month of July 2020, and I will give you the data for the month of July 2021 for the different days. For the different days, there are two different periods. This is your stock price. Right? So then for the different days, let July I have given on July 1st, July 2nd, then let maybe 3rd, 4th was holiday, then 5th, 7th, 6th, 7th, 8th, and so on. And I will give you the prices of these. I am denoting it as X1, X2, and up to your, let it is 30 or 20, and I can write up to X20. And in the July 21 also, we have the prices of the different days, and we can write it as Y1, Y2, up to this Y20. Then whenever we have the prices in two different dates, what basically we need? We need sigma x, we need sigma y, we need sigma x square, we need sigma y square. So what basically you have to do first, you have to first calculate the change in the price, because these are the actual price data which has been given to you, but we need the return data. So first of all, we have to calculate the change in the prices. So for example, if here it is written, let 650, it is written 665. Then again you have to make another column. Let next period it is written 685, or then it is written 685. Let 705, like that. If the prices are written in this way, or prices are prevailed in the market in this way, then what basically we have to do, we have to first calculate the price change in two different periods. We have to calculate the price change of the X, then you can have the price change of Y, then we can have the obviously X square, and we can calculate the Y square, then XY. Okay. So let X was 665 minus 50, that is 15, right? This minus this, that you got it 15. So then you can find next period, it is basically 685 minus 65, that is let 20. Then it is 685 minus 85, that is 0, and so on, like that. On depending upon the price change, you will find the how the price is basically changing across the time. Then finally, what basically you can do, same thing you can do it for this period also. You repeat it for this period. Then find out the square of this. Let 15 square of 15 is 225. It is 400, 0, and so on. Then like that you can calculate for y square also. Then you multiply this and find out your xy. And once basically you find out this thing, then what we do, we find out this summation of x square, then find out the summation of y square. Let I assume the summation of x square is, let I assume that 1590. Let summation of y square, we find that is little bit higher number, 315,270.625. Let summation of xi, summation of xy, you find let minus 830.375. Now once you got this, then you can find also summation of x, let that is 65. Then you can get the summation of y, let that is minus 215, assume, and x bar, this is let 3.25. Then your y bar is equal to minus 10.75. Then x bar square is equal to automatic 10.5625. Then your y bar square, that will be 115.5625. Once you calculate this, then you can put these values in this formula, then you find your r square. First you calculate your b, that is your sigma xy minus 830.375 minus, you have the n is equal to, let we have taken 20, number of periods, number of data points, that is 20. Then 20 into xy bar, this let xy bar basically is 3 point, sorry, we have not calculated here. We can n into x bar y bar, you can write. X bar is equal to 3.25. It is x bar y bar 3.25 into your, what is that, minus 10.75 divided by nx square sigma x square, that is your 1590 minus 20 into x bar square, that is basically sigma x square is equal to what, 1590 minus 20 into nx bar square, and x bar square is equal to 10.5625. 10.5625. Then let BU got minus 0.095. And once BU get, then using this value, this formula, you can get A. And once you get A, then you can put these values in the R square. And let you find your R square value has come 3.9 into 10 to the power minus 5. So you can find out your R from there. So that is 3.9 into 10 to the power minus 5 square root. That will come 0.0063. So now, if you see that whether this R more or less is very small, this particular, this is basically your coefficient, the correlation coefficient, the autocorrelation coefficient. So whenever we have checked it, what basically we find that the correlation between the prices in two different periods, this period and this period, is very small. And you can also check the statistical significance level. I'm not going into that. Then if it is very small and statistically insignificant, then we can conclude that the prices move in a random fashion. The prices are basically independent. The prices are independent. That means in this particular data set, if you are using, then we can conclude that the market is basically weakly efficient. If the autocorrelation coefficient is basically is very small, it is more or less close to 0, then as well as it is statistically significant, or it is very insignificant in terms of the value, that basically you can also conclude. If it is insignificant in terms of the values, then basically as per the theory, we should get that the value should be close to 0. But in the practical sense, it will not be close to 0. But it will be, it is not exactly 0, it may be close to 0. So in that case, what basically we can say that there is no such relationship exists between the prices of the two different periods. So that's why market moves independently, and we can conclude that the market is weakly efficient. So that's why there is an insignificant correlation for such kind of combinations or such kind of relationships. Always we can find. So that is the one test. But more popular test, basically for the weak form of efficient market hypothesis, that is basically always we use. That is basically the Ron test. So Ron test is more popular for testing the weak form of efficient market hypothesis. So what exactly the Ron means? Anybody can tell me what is Ron? Yes? Hello? Am I audible? आज क्या हो रहा है?
Yes, sir, you are.
I'm audible. Sneha, Ron क्या है?
I don't know, sir.
Don't know. Anybody has idea about Ron? Priyansa?
Yes, sir. No, sir, I don't have idea.
Yes sir, फिर no sir, उसका मतलब yes sir मतलब क्या है? तुम जो बोले yes sir मतलब you know the huh?
No, sir, like I was answering to your call.
Okay, but you don't have idea about the Ron test?
No, sir.
Okay. Priyam? No? Ayush? Are you there? Or you have joined and after that you slept?
दो पोहा भाई.
Hello? Anyway. Okay, let me explain you what we mean by a RON. A RON is basically what? For example, if it is basically a kind of sequence of identical occurrence. The RON is defined as a sequence of identical occurrences preceded and followed by the different occurrences. Okay, what does it mean? For example, if I write, let me write one example in this case. I have the data of a particular kind of stock. Okay, let 2020 April. Okay, I have the stock price data with me. Let I have written that for a particular stock X. Stock X. This particular price data is available with me. Let this price data is, let I will write 881.5. Assume for day 1. Let for day 2 it has become 856.5. Let for day 3 it has become 859.75. For day 4 it has become 918.5. Assume. And next day it has become 1010.25. Then next day, it may be the next day or maybe it is a holiday, then maybe it is the next to next day. Forget about the dates. Then this data may be 1072.25. Then maybe next period it has become 1074.5. Then again next period it has become date 1123. Okay. Then next to next period it has become 101203. And next it has become late 1256. Then next period it has late become 1341. Then that is become 1469. And then it has become 1450. Then it is 1306. Then 1258. These are the hypothetical numbers. Then how basically we can calculate our RON? You see, first day it was 881.5. Second day it has become 856.5. So there is a negative trend. After that it has again increased. So this is basically one RON. This is one RON. And this is negative RON. Your sign will be negative. After that, if you see 859.75, 918.5, 1010, then it is increasing only 1072, 1074, 1123, 1203, 1256 up to 1469. If you see, there was an increasing trend. See, whole particular period, if you see this to this is increasing. So here we are putting a negative sign. Now it has increased, so that's why this is plus, this is plus, this is again plus, this is plus, this is plus, 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 plus. Up to this, it is plus. And this particular, this is one run. This is one run. This is another run. After that, it has again declined. You see. So 1450, 1306, 1258. So that is a declining trend. This is negative. This is negative. This is negative. Right? And this is one run, R3. Late in the next period, the data has become 1330. So then this is again positive. So this is a single run, one run, because up to this basically let the data is available. So this is what basically the run we can define. Up to what is that number of a run is basically a sequence of identical occurrences proceeded and followed by different occurrences. That is what basically run is defined. A run basically occurs when two consecutive changes are the same or two or more consecutive positive or negative price changes constitute one run. One positive or negative price changes which is happening, that basically will form one run. That is what basically the run is. Now the question is that this is the data which is available to us. Then we have to examine that whether these particular runs are different from zero or not. Okay. So in case the sign has changed from a plus to minus, from minus to plus, a new run is basically formed, that already you know. So in this case, I am denoting it. The total number of runs is how much in this data? Tell me.
4.
4. We can denote it as R. Let R that is equal to 4. Number of positive price changes, how many? Positive price changes.
2.
Very. Is total 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Yes? Are you getting my point?
Yes, sir.
How many times there is a positive price changes? I am denoting it as N1. That is 11. Then your number of negative price changes?
4.
4. 1, 2, 3, 4 is equal to 4. Then how many were the total numbers? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. Then ये obviously 15 ही होगा. 1 कम होगा क्योंकि first observations whenever we compare, then that comparison, before that no data is available, that's why the total will be 15. So now what basically we have to check? We have to check whether your number of runs that is statistically significant or not, right? So for that, we have to calculate the mean and standard deviation of the positive and negative price changes of the data, because we have to establish a confidence interval. I hope you must have studied this in probability and probability and statistics, that confidence interval approach and the level of significance approach? Yes or no?
Yes, sir.
Yeah. So we have to make a particular range, a confidence interval for this at a particular level of confidence or level of significance. And accordingly, we can test whether this number of runs are statistically significant in that case or not. So first of all, you calculate the mean. What is the mean of this particular series? So formula for the mean will be 2n1 n2 divided by n1 plus n2 plus 1. 2n1 n2 divided by n1 plus n2 plus 1, right? That is the mean. Then it will be 2 into 11 into 4 divided by 15. 11 plus 4, that is 15. That is how much this is? 88. 88 by 15. Kitna बार है? Tell me. 5.87. 5.87. Okay. Then you calculate the standard deviation. The standard deviation formula will be 2n1 n2 into 2n1 n2 minus n1 minus n2 divided by n1 plus n2 whole square into n1 plus n2 minus 1 square root. This is the variance formula. Then you can take the square root of this. How much you are getting? 2 into n1 n2 हो गया 44. Then it will be 88 minus n1 minus n2 means minus 15 divided by 15 square of the 15, that is 225 into n1 plus n2 is equal to 15 minus 1, that is 14. The square root of this. कितना आया रे? बताओ.
$1.428.
1.42.
Yes.
Okay. So your standard deviation has become 1.42. Your mean has become 5.78 for that particular change series. Okay. So now what basically you have to do? We have to make a upper limit and lower limit at a particular significance level or the confidence level. Let you assume this particular data series is following a standard normal distribution. You assume. So what is the value of Z at 5% level? Huh? At 5% level of significance, what is the value of Z? Yes?
1.96.
1.96. Okay. So if you assume generally in statistics we go by below 5% only, 5% or 1% and all these things. So at a 5% level of significance, your value of Z will be 1.96. Now in this particular 5% level, we can now make our upper limit and the lower limit, right? So what will be the upper limit? Yes, upper limit का formula क्या है रे?
5.87 plus 1.42 into 1.96.
1.96. 5.87, right, plus 1.96 into कितना था 1.42, right, 1.42 कितना आया? Anybody can say? Hmm.
8.65.
8.65. Okay, good. Then lower limit will be 5.87 minus, right, 1.96 into 1.42. वो कितना है?
3.09.
3.09. Now you got your upper limit 8.45 and your lower limit is 3.09. अभी तुम्हारा नंबर ऑफ रन्स कितना है? 4 है कि नहीं? टोटल नंबर ऑफ रन्स आर 4. Yes or no? If total number of runs are 4, अभी जो 4 है वो 4 figure is coming within this particular range or not? Within these limits?
Yes, sir.
So if they are coming within the limits, then what we can conclude? The null hypothesis is accepted or it is rejected? If these values are coming within this particular limit, then what basically we can conclude? Yes?
So null hypothesis is accepted.
Okay, so what is your null hypothesis here? I have not told you what is the null hypothesis, right? The null hypothesis
Yes,
is
sir, I think.
the null hypothesis here is there is no relationship between the different prices across the period, or you can say that basically the prices are independent to each other. The prices of the different periods are independent to each other. So that is your null hypothesis. That means what basically we can say, if this particular number of runs is coming within this particular range, we can conclude that the prices are independent at 5% level of significance, and that means your market is weakly efficient. That means the price is behaving randomly. There is no such kind of particular trend or particular pattern the price is following, and there is no such interdependence exists between the different prices of the different periods. So because of that, we can conclude that the market is basically the market is weakly efficient. The market is weakly efficient. So if within this particular range, your upper limit, lower limit, whenever you fix, and your number of runs basically comes within this particular range, then we can say that now your 3.09 is less than 4 and it is less than 8.65. So if that is the thing what we are getting, it says that market is weakly efficient. If number of rounds will not come within this particular range, then we can say that market is inefficient. We can conclude that the market is inefficient. Okay. So in this case, basically what we say that these are the two major statistical tests basically people use whenever they basically we can call it test this weak form of efficient market hypothesis. Another one basically what basically sometimes there is the trading rules or the filter rules, what we call it. These are basically we can say that a subjective kind of judgment, a subjective kind of judgment these investors make. Okay. For example, what the filter rule tells: the investor trades in a stock when the price change exceeds the filter value set for it. So that's why there are a number of types of orders which are available. Any investor who wants to trade in a particular stock, if he or she will feel that the price is exceeding that particular value, then they can go for it. Okay. But if the behavior of the stock price is random or stock price changes are random, then these filter rules basically will not work, or anybody is following that strategy will not get more return than the other investor who are basically investing with a very traditional buy and hold strategy. So any investor who is following that particular kind of strategy or any kind of number they have fixed in their mind, and accordingly they trade in the market, if we are assuming that that investor will get more return in comparison to the other investors who are basically investing in a passive way, holding following this buy and hold strategy, then we can say that they if using the filter rule somebody is getting return, then the market is inefficient. But if the behavior of the stock prices are random, then the filter rules will not work. This kind of rule will not work. So in that particular case, the particularly what we can say, this investors will not supersede always to other investors who are not following that particular strategy. So that is what basically what we can call it the test of trading rules. But there is no such kind of empirical way of looking at that thing. But generally, people feel that okay, if this price will go up to this, of the price earning ratio will be 5, then the stock will grow. But that is the only the intuition. But that intuition may work or may not work in the market whenever they want to extract more return from this. So that's why that is another way of testing this efficient market hypothesis, the weak form of efficient market hypothesis. Okay. Then we can move towards the semi-strong form of efficient market hypothesis. How this testing is done, or how basically we can test whether your market is semi-strongly efficient or not. I will continue, or you need a 5 minutes break?
So break.
Break, sir.
Okay.